you today. So the idea is for us. May I ask you, Daniel, if you try to share your presentation?
Let me try. I think should work.
Yeah. Okay. Yeah, that's good. So I'm going to introduce you in Spanish, and then you can afterwards you can start your lesson. Buenos días a todos, muchas gracias por estar conectados temprano. Les presento al doctor Daniel Dalvia. Él es profesor de los temas de finanzas corporativas y regulación financiera de la Universidad de Queen Mary en el Centro de Estudios de Derecho Comercial. Pues su educación su formación mejor, es una combinación entre escuela italiana y la británica. Obtuvo su doctorado hace algo más de 6 años de la Universidad de Birkbeck en temas de finanzas corporativas. En un discurso muy, digamos, cercano al que ustedes escucharon ayer de la profesora Joy Malala, el día de hoy van a explorar con el profesor Dalvia el funcionamiento de una parte del mercado de los ETF y él pues naturalmente les va a explicar cada una de esas transacciones. Especialmente, digamos, en el contexto de la negociación de derivados financieros y contratos de compra-venta que involucran acciones y especialmente pues la negociación de Bitcoin como activo subyacente. De varios de los conceptos de pronto que se vean durante el día de hoy alrededor de este tipo de contratos, mañana en la sesión que está a mi cargo, iremos despacio para entender, digamos, desde las nociones, esta idea de activo subyacente, ¿no? Entonces, para que lo tengan presente y puedan combinar todas estas sesiones y estos temas. So, without further ado, Daniel, if you want to start your lesson, I'll be here just in case you need anything. And again, thank you for joining us today.
Thanks for having me. It's a pleasure, as always. Actually, today I'm going to present some points that they relate to fund management. And in general, if you want, I mean, we can even make this session quite interactive in the sense that I might ask you questions, or even you are always free to interrupt me if you want, for example, a clarification of a concept, or if you don't know what does it mean, a concept in particular. So I'm happy to do, so don't worry and don't be shy, essentially. You can interrupt me. So I think now you can see my slides, and I shared the screen, the full screen. We can start essentially, I mean, by giving you a presentation of ideas that they relate to traditional finance. So, for example, I wanted to ask, once I speak about traditional finance, what is something that is coming up in your mind? What is, in your view, traditional finance? ¿Cuáles sus opiniones su traditional finance? What do you define as traditional finance? I think, Sally, you wanted to say something, but you are mute.
Anyone wants to share the views about what you understand about traditional finance?
I think Sally wanted to do something. Or,
no, always maybe what we when we think in finance maybe is the incomes that we have and what is our, I don't know how you say egresos in English.
Egresos.
Yeah.
Expenses.
Yeah. So we our personal, you know, how we receive money and how much money is all the yes.
Yes. Any other view also? I mean, I think something that you said is about money. So money, it's important in finance. Anna Maria?
Yes, can you hear me?
Yes, I can.
Possible is a study of the many money of assessment.
The study of money?
Yeah.
Yes, yes, the study of money and, for example, what is money in general? Do you want?
We have different concepts because today we have the virtual, I don't know how do you say, but virtual money, I guess.
Yes, virtual currencies. So essentially, yes, you already outlined that today we have a conception of private money. So private money, because they are different from public money. So what are public money? What is public money?
I don't know, but possible the topic that we can have to create a difference is the, I don't know how do you say, but the person who manage the money, possible to say the public, what is public money?
Yeah, essentially public money. Yeah, I understand that you wanted to connect this to a conception within maybe the sphere, public sphere. But money, I mean, in general, any kind of money, private or public, they will always pass through public hands. So really, I mean, I can pay with money, you can pay with money, public administrations that they can pay with money. So in reality, money are a little bit everywhere. But as a categorization, we can say that public money are the money related to in reality, I mean, to monetary sovereignty. So only that is public money. Is the money, for example, $1. That $1 currency bill is public money because it's issued in the United States. It's representing the government. In reality, I mean, it's the central bank that will issue and print that public money. And so that is public money because the central bank is always within a conception of the state and within a conception of centralized finance. So a conception where there is an intermediary, and this intermediary is a central bank that is printing money. So that is the conception of public money, different from private money, because private money is, as you said, virtual currencies, can be Bitcoin, can be Ethereum, can be, for example, stable coins, and stable coins, they peg their value against hard currencies. What is an hard currency? The dollar, for example, US dollar. So in se, per se, the stablecoin does not have any value if not connected to the hard currency, so to a public currency that is public money, that is the US dollar, the euro, or any other hard currencies that you can think of. So when I speak about hard currency, it's because I speak about the supremacy of that currency in the world in comparison to other currencies that probably they have also today an exchange rate against the hard currencies that is lower in terms of exchange rate. Until here, everything is clear to you? Or there is something that is not clear? I think I take this as something that, I mean, should be clear. So if it is clear, we understood that money is important. Then if money is important, the question after, I mean, can be what we do with all this money. And here in the slides, I mean, you can start to have an idea, because if you speak about ancient Romans, I am Italian and I am originally from Rome. So I know very well the history of Rome and the history of the Roman Empire. And actually in South America also, your civil codes are all based on Roman law. So the, let's say, influence of ancient Rome is in many angles, is on the fact of the law, is on the fact of even resolution of possible litigation through arbitration that was invented in ancient Rome. And the same thing also the finance that you think of today has been invented in ancient Rome. So in reality it's nothing new. It's something that in reality, I mean, for example, even if you think about bailout, that is the procedure through which the government is going to inject money in the banking sector in order to save the banking system, this is something that already was done under the Emperor Hadrian in ancient Rome. So everything that you see today in reality is not very new, as always a root that is very, very ancient. In fact, ancient Rome, because was an empire that lasted at least for 2000 years. So lasted much, much more years than, for example, modern empires like the British Empire. Not only, but the influence of ancient Rome is a little bit everywhere. It's even in the names. For example, even, I don't know, if you think about American presidents, they like to think about America as a republic. And in this way, the republic was a period in Rome. Within the republic, there might be also people that are more influent. And in fact, I don't know, for example, if you have read on Bloomberg, Bloomberg was titling and addressing Trump as the new Caesar. So the influence of Rome is massive, even in our speaking of today, in all the things that are political, all the things that are related to law, and all the things that are related to finance. So we can say that traditional finance has very ancient roots. And speaking about money, money, in fact, and this conception of public money was invented in ancient Rome. So we had, for example, coins, and these coins, there was the face of the emperor. So in reality, were public money. And so there was an authority issuing the money. Otherwise, there was no value in that money. So this idea, in reality, I mean, is not modern. It's something that has very old origins. In terms of what we do with all that money, they can represent a pool of money. So we can put all the money together. And then we need to find ways to invest those money. So we have a concentration pool of capital that also means, of course, a concentration of risk. And today, if you look at, for example, what is an hedge fund, what is a mutual fund, what are money market makers, all those actors in financial markets, they practice and they do the same functions that in ancient Rome, for example, specific individuals or corporations they were doing once they were financing with all that money, private money because they were money of investors. And so all this money that they were then collected, they were invested maybe in a business venture. Maybe they were invested in a voyage by the sea. And the voyage by the sea, in fact, is the first form through which those money they start to circulate, but also is the first form that is telling you there is risk. Because why there is risk if I take a voyage by the sea? Maybe I need, I don't know, to carry or even to go in one country by the sea, then take and load the boat, and then I need to come back maybe in Italy, in Rome, because there were merchants, for example, that they bought some items. What kind of risk you can face if you are on the boat and if you are, in reality, I mean, the one that is carrying out the voyage? What are the risks of a voyage by the sea, in your view?
I don't know, one could be drowning or the pirates.
the pirate.
Studying at least.
Yeah, exactly. Can be the pirates, can be the fact that the ship can drown. And so, in reality, all this risk needs to be insured. So even the concept of insurance, born in ancient Rome. And this kind of taking risk, this kind of activity of taking risk is something that in reality, I mean, has ancient origin, and it is the historical, I mean, idea, but also is telling you that, I mean, there are forms of finance, because that was a form of financing, that are very similar to things that we do today. For example, the voyage by the sea and this concentration and pooling of capital, and then directing, channeling the capital to finance maybe a voyage by the sea, that was the equivalent of what hedge funds they do today, because they have a lot of money and they invest in very risky assets. And so maybe you can win, maybe not. Sometimes you can insure against hedge your position. And if you want to hedge your position, you enter in some, for example, derivatives instrument in our modern contemporary finance. So maybe if there is an exposure, this exposure in reality can be hedged with the use of derivatives. And Catherine, I mean, she's very expert on this topic. So essentially, this is my first understanding that I wanted to give you, that everything that we have today, and even now, once I will speak about ETF, or maybe I will speak about hedge funds, or if I speak about mutual funds, they are not new as a conception, because this conception of a fund to have this collection of capital, concentration of capital, pool of capital, is from ancient Rome. So, and then the next question is always, once I have this pool of capital, how, as a manager, for example, a fund, mutual fund manager or hedge fund manager, how I can direct that money, that capital, in a direction that is profitable for my fund, but also for the investors of my fund, how I can create and generate return on the investment. And the same ideas and the same questions were in ancient Rome. Of course, they didn't have still at the time, for example, the conception of what is a financial market. They didn't have maybe the idea of what is a stock exchange, because this stock exchange idea is something that is will come later on in the 17th century. So, for example, here in the slide you have the VOC. The VOC was the East India Company, United East India Company of Dutch Republic. So in the 17th century, the Dutch Republic, that was in Netherlands. In Netherlands, in Europe, became even more powerful in the 17th century, the finance of the VOC, in comparison to even London. And why? Because actually the Dutch, they were the first that they invented the modern idea of the corporation. And the corporation had one main feature, that is limited liability. So if I am a shareholder, I can contribute to the corporation, but my contribution is limited. So in reality, my exposure, my liability will be limited to my contribution. So if I invest 10 euros or I don't know, $10 per share, and I buy shares, and then I buy maybe the value of each share is $10, and so I buy 3 shares, I spend $30. But I cannot then respond if the corporation is going to collapse or to fail more than what I contributed. So in case I lost $30 if the corporation is going to fail. So this kind of financial innovation that is the corporation is something that in modern ways, born in the Dutch Republic during the 17th century. But even that, of course, had the same idea of ancient Rome. So the same question was always the same. At the time of the VOC, the question was a little bit different because it was a different period. but always the management, the managers of the corporation of the VOC in Amsterdam in the 17th century, they ask themselves, what we do with all this money? There is always a collection of money, and then we need to use this money to finance maybe a business, an enterprise, a business venture. In that case of the VOC was not by the sea, but was by the land. And so they went, for example, very far in Asia, because in Asia they wanted to buy or to find spices, and then to bring back in Europe spices. The VOC is very remarkable as a story because essentially also is very well connected to the birth of the first stock market in the world, that is Amsterdam Stock Exchange. And it is done because at the time, the managers of the VOC, as I told you, if I invest money in a corporation, then I need a return. And the managers, they should create return for their own shareholders. And so what they did, during the first 20 years, 10 years of creation of the VOC, the return, they were not high, there was no liquidity, there was no cash to be distributed as dividends to shareholders. And so they asked shareholders if they wanted to be paid in spices instead. Some of them, they accepted the spices, but the problem with the spices is that where I can, for example, store the spices, this is something that can be problematic. So some of them, they had another idea and they started to, in reality, sell share certificates. So they started to sell share certificates and they did this in a market, like a market that was designed not to sell shares. It was a market where you could find, if you wanted to buy or to sell meat or spices, whatever you wanted for normal life in reality, or maybe even things that they relate maybe to the house, utensils and so on. At the time, I mean, the merchants and the shareholders of the VOC, because they wanted cash and they wanted liquidity, they started to sell share certificates. And then in that market, they found some buyers. And so the new buyers, they became the new shareholders. And that is a secondary market because it's investor to investor. And then was created in this way. This is how, in reality, capital markets, they born not with the primary market, but they born through the secondary market. They born through this business that is investor to investor. But always there is the same question. In reality, I mean, you see, money is important. And so even the shareholders of the VOC in the 17th century in Amsterdam, they needed cash, they needed liquidity, they needed money. So, and this is something that they could not find easily. And this kind of difficulty could create another financial innovation that then was the stock market. So in reality, history and financial history is very interesting because you can see how many things that you speak about today are not new. And if you think about the corporation, if you think about this concentration of money and capital and what we do with those money and how we can finance enterprises, businesses, and also business ventures and so on, is something that still today we ask, and is something that relates to the concept of traditional finance. So for this reason, I say in the slides, traditional finance, it existed for more than 2000 years in financial history. And it's the finance that we know how it is. What we don't know in reality, or maybe something that is very, very new, and this is something, I mean, it's just for you, but it's very quick. In reality, this is the conception of traditional finance, because within traditional finance, of course, we had also the first idea of what is a bank. And so there, within the conception of banks, sometimes they lack liquidity and they can access the lender of last resort, for example, that is provided by central banks. So central banks, they are injecting liquidity to banks that are likely to fail. But also traditional finance is important in terms if we think about the bank, it's the bank that is lending money out to small, medium enterprises. Traditional finance is very well connected essentially with the even conception of a commercial bank. And the conception of a commercial bank, even there, born in Italy, with the idea of the Medici Bank. So Medici was a family during the 15th century, so during in reality the period of Renaissance in Italy and Europe. So they invented the bank because they invented, especially if you see here, there is a painting. This painting and the man in the painting is Luca Pacioli. Luca Pacioli was a friar, but was also a mathematician. So in reality, he invented the double entry bookkeeping. So if you see today a balance sheet and there is liability asset, this is something that was invented in Italy by Luca Pacioli. And is something through which today, in fact, the original explanation of asset and liabilities is from Italian. And in fact, the liabilities, it was called vostro. Vostro because it's something that I need to pay you. And then there was nostro. Nostro were the assets, because that is something that belongs to me. It's something that I own. I own the assets. I own my own investments. And what is the business of a bank is to take, in reality, deposits and then to lend out that deposits to make investments. So in reality, to maybe lend to business enterprises, small and medium enterprises especially. There is also a problem because, of course, usually in this idea of traditional finance, in this idea of traditional banking, we have depositors that we are also depositors. I mean, many of us are depositors of banks. And what happens is that maybe we run out of money, we want to withdraw money, or maybe if I have a very high level of deposits in a bank and I see that there is an environment with high interest rate, I might even, I don't know, want to invest my money somewhere else. So I might even withdraw all that money. This kind of withdrawal of money from the bank can cause a bank run, because if all of us we are depositors and at the same time we ask money back, that are deposits in this way are money for this reason, so we ask our money back. And it is something that can create a bank run, because then the bank has to pay us. So those are demand deposits are called, because I deposit money. Legally, at that moment, it's no more my money, it's the money of the banker. But it's true that the banker has an obligation to pay me at demand. So if I want my money back today, I should have my money back today. And this is something that if all of us, we ask the money at the same time and we want all our money back, the banker maybe can run out of liquidity. What is liquidity, in your view? Liquidity is the ability to turn that asset into cash. So I can sell the asset, and once I sell the asset, I capitalize my investment. So I turn back the investment into cash, and with the cash I can pay maybe the depositors. If there are too many requests, probably I'm not able to do this. So I need to go to the lender of last resort. And I'm subject, usually within the banking sector, to specific prudential regulations. So there is prudential supervision by the central bank or by a different authority. So in reality, I mean, now this lecture is not about banking, but it's important that you have an idea of traditional finance, because within traditional finance, we started also to see, and this is something that, I mean, you can see in the global financial crisis, you can see especially in our contemporary financial markets, the rise of shadow banking. So in reality, what is shadow banking in your view? Because there is the banking sector, that is the traditional commercial banking sector. So there are banks, they take your money, they invest your money, and they finance the economy. And that is the banking sector. And they are subject to very specific rules, and they are subject in reality to prudential supervision, but also they have the right to go to ask money to the central bank, and the central bank might give this money to the bank. So they have obligations, but they have also rights, banks. What happened to all the other actors, like the non-bank financial intermediaries, that they are mutual funds, hedge funds, ETF, and so on, even stablecoin providers? What happened to them? They are not banks or commercial banks, but they are shadow banks. So what is the real difference in your view between a shadow bank and a bank? Well, we speak about shadow banks. I don't know, you want to try? Essentially, I mean, we speak about shadow banks because it's something different from banks. So shadow banks are the non-bank financial intermediaries that might also sometimes play the role of a bank, because they might also have some kind of mechanism that are similar to the mechanism that I was telling you before. So like the bank is going to take deposits and then to lend out these deposits. For example, there was in decentralized finance, that is the finance that you said about virtual currencies, there was an intermediary that was called Celsius. Celsius then failed, but that Celsius was a crypto bank. So they were doing the same business of traditional finance. But actually, that actor of financial market was within the centralized finance. So something that is different. Why decentralized? Decentralized because there is not an intermediary like a central bank. You don't need the approval, at least until now, of a specific regulator in order to operate. And you might, in reality, maybe perform a role similar to a bank, although you are not a bank, and so you are not subject, if you are not a bank, you are not subject to intense prudential supervision. And you don't have also the right, usually, to the lender of last resort. So there is this kind of connection that is quite interesting. And it is called shadow banks. And here you have even a say from the IMF that it says, uses this thought-provoking proverb, if it looks like a duck, quacks like a duck, and acts like a duck, then it is a duck, or so the saying goes. However, what about an institution that looks like a bank, acts like a bank, often is not a bank, it is a shadow bank. So that is a good, in reality, I mean, quotation, in order to tell you and to say what actually I'm speaking about. I'm speaking about today actors that are non-bank financial intermediaries. They are not usually or traditionally subject to those 4 pillars of traditional finance. But you might already understand, if I am a stablecoin provider, and then you remember Luna Terra in 2021, then 2022, there was the crypto winter of decentralized currencies. And so there are many regulators that started to think, why not we extend the borders? Why not we maybe provide some of those non-bank financial institutions with the same protections of traditional finance? For example, Celsius, that was a crypto bank, was not subject to insured deposit taking. So that created, for example, a very big loss for customers of Celsius. Celsius could not go to the central bank and ask for the lender of last resort because it was not within traditional finance. And now, in fact, there are people that they think, why not we extend also the lender of last resort for those actors? But actually this, I am not agreeing with them. I mean, we should not allow a contamination of traditional finance with decentralized finance. The two, they should be in reality separated, because traditional finance has an history of 2000 years. Decentralized finance has a very modern history and quite short history in comparison of 2000 years. So in reality, if you might extend the rules designed for traditional finance to some non-bank financial intermediaries that traditionally are within the shadow banking sector, this might create in reality a contamination of rules and might create also confusion, but also might spread systemic risk. So in reality might create a sort of channel through which in reality the two sectors they contaminate each other, and so the entire also banking system they might be subject to more financial crisis, even more than what we see today. And example actually, I mean, is here is the border problem. That is the thing that I was telling you now, that we can extend regulation of traditional finance to other actors. These are the other actors, so in reality, the non-bank financial intermediaries that I was telling you, and so are private equity funds, mutual funds, hedge funds, can be even broker-dealers, can even be, for example, everyone that is not a commercial bank, everyone that is not an investment bank, essentially. So this is something that relates to a problem that is quite modern, and as you can see in this financial stability report that is monitoring the sector every year of growing of non-bank financial intermediaries, we had a quite high level of growing of the sector. So the sector changed completely. The sector is expanding because as you can see, the green one is the non-bank financial intermediary sector, and you can see that, I mean, has grown between 2020 and 2022 close to 200 USD trillion. So as became during the years from 2004 2022 has grown quite exponentially. This is the reason why today, and even since the collapse of FTX, that was a crypto exchange, many regulators, they think we should extend the regulation of traditional finance, especially for the protection of customers, especially for the protection of other actors that they relate in reality to problems that are similar, because if I am an investor of stable coins and then maybe I can lose all my money, the same thing can be faced by a depositor of a bank. So the final result, if an institution, financial institution is going to collapse, is the same, because usually it's the customer, retail customer, that can be subject to pain, essentially. So we need insurance. We need, for example, for banks, we have deposit insurance, but this is something within traditional finance. So the question is, can we extend also these to non-bank financial intermediaries, such as a stablecoin provider, for example, or such as investors that they invest in a mutual fund, because even you can open your account with a mutual fund. So can we have maybe deposit protection for you? That is the idea. But this idea born in traditional finance, not within this other sector. Until here, everything is clear? Or any question that you want to ask? Clarification? Okay. So now here you have all the things that I told you until now, and you had also especially the proof of what I'm saying. Because if you look at the March Madness, was in 2023. That was the moment where Silicon Valley Bank failed. But within Silicon Valley Bank, one depositor of Silicon Valley Bank was a very big producer, creator of stablecoin. So in reality, these stablecoins were pegged against the US dollar currency. If that depositor, in that case, that was Circle, was going to fail, because essentially, I mean, I think he had some billion deposited in Silicon Valley Bank. If then, for example, the regulator and the authorities, they could not pay back the deposit of Circle, this indirectly, the possible collapse of Circle could have also triggered a collapse of the stability of the currency of the US dollar. So for this reason, President Biden, by that time, signed a specific and extraordinary order in order to cover all the depositors of Silicon Valley Bank, including that stablecoin provider. In Silicon Valley Bank, of course, in any case, the depositors, they had a big problem because Silicon Valley Bank was traditionally the bank for startups. So all the startups, they could die, essentially. And there were, of course, if you don't know, within the depositors, usually the rule in the US is that you are insured for your money that you deposit up to the amount of $250,000. So everything that is above to $250,000 is not insured. So you can lose all your money. So that what happened essentially is that was remarkable. I mean, President Biden did something that was unprecedented. Bypassed the rule of the Federal Insurance Deposit Corporation, that is the agency of the government, of the US government, that is deputed to insure depositors up to the amount of $250,000, not beyond that. But in the case of Silicon Valley Bank, no depositor lost money. And the main reason is actually this reason of contamination that there was between traditional finance, because Silicon Valley Bank was a commercial bank, and the non-traditional finance, and specifically the decentralized finance of a stablecoin provider that was depositing those tokens within Silicon Valley Bank. And those tokens, they have the equivalent value of more than 1 billion in terms of dollars. So it was a very big depositor in terms of value. And this triggered a bank run. In this bank run, then, in any case, they were saved. I mean, there was a good option there. So this is why I put in the slides, and this is the example of the things that I'm telling you until now. If there is a contamination of traditional finance with decentralized finance, this is not going well. If there is this contamination, in reality, we might face, as we did, a failure of Silicon Valley Bank, but then we also saw a failure of Signature Bank. And Signature Bank, in reality, was connected to also FTX. So even there are some banks that even they might accept for business more stablecoin providers, more crypto exchanges. And this is something that this kind of encounter is creating a sort of channel that might spread systemic risk into the economy. So this is now you have the basis, in reality, to understand what we are speaking about. So we are speaking about today non-bank financial intermediaries. One is that ATF. ATF are specific funds, and they are non-bank financial intermediaries. But then we have also decentralized finance. So maybe a stablecoin provider, maybe a crypto bank. That is not traditional finance. that is decentralized finance. So they don't need an intermediary. And this is in reality how, because they are different from the traditional actors of finance, still they might create problems that are similar. So because these problems are similar, the regulators that they are usually, they are used and they were used to regulate traditional finance, the only idea that they have is to extend possible rules of tradition designed for traditional finance to others that are beyond traditional. They are completely within non-traditional finance. They are completely non-bank financial intermediaries. They are completely shadow banks. So they act as a bank, but they are not a bank in the traditional term. So even an ETF might be similar in some problems, like liquidity. They might be similar to the same problem of a liquidity risk that a commercial bank is facing. So the problem is the same, but what is different is the actor and the rules that they apply to that actor. Is this concept clear? Because I know that it's not simple. It's not very simple. So I wanted, and I was telling you more time also because your first language is not English. It's not even mine because I'm Italian. But essentially I've been living in London for 13 years. So I'm more used to English probably. So I wanted to be sure that you can follow me. Any question? Okay, I take from your silence that I think we should be on the same page. So ETFs, they were born in the United States. As you can see, if there was a moment in history that at the start was more European, the contemporary history and the modern history of financial markets and financial actors that are specifically non-bank financial intermediaries is more an American history. And in fact, even in terms of exchanges, it's true that the first exchange in the world was Amsterdam. So in reality, Amsterdam Stock Exchange was the first. But then we had in the US the rise of New York Stock Exchange. Then in the 70s, we had NASDAQ. So essentially, the US capital markets are the most liquid in the world. So there is a lot of buyers, sellers, and everyone wants to get listed in New York. So for this reason, in reality, for this I say that the history, if we think about history of modern finance, is an American history. And unfortunately, it's not always good history. There are also negative points in that history. Because if we think about the global financial crisis, that came from the US. If we think about the March Madness, so Silicon Valley Bank collapse in March 2023, came from the US. And it's also true that, maybe an American can tell me that in Switzerland, Credit Suisse failed. So even us, we have our problem. It's not only an American problem. But it's true that probably this kind of financial innovations like CDS, this kind of financial innovation like the mutual fund, the hedge fund, because even the hedge fund ETFs, so they were all born in the US. And the ETF, in reality, also they can create systemic risk. What are ETFs? They are a typology of fund. And the ETF, as every fund, is a corporation. As every corporation, they have shares. So you can invest in an ETF because you can buy ETF shares. These ETF shares, they in reality, replicate the value of the shares of an underlying portfolio. So in reality, maybe they might replicate the value of Bitcoin. They don't hold Bitcoin, but maybe they are replicating the value of derivative contracts that they are connected to Bitcoin, like futures, because Bitcoin as a cryptocurrency is considered as a commodity. And so you can use futures in relation to Bitcoin. So sometimes the shares, the value of the shares of the ETF is going to replicate especially and to track the value of the Standard & Poor's 500 or the Nasdaq or Fortune 500, Dow Jones. So those are all indexes, and these indexes, they are providing a value through which the value of the shares of the ETF is traded. So it's an American innovation, it's a financial innovation, because you can still invest in something without holding that something. So that is the innovation. Now, of course, even the ETFs as a fund, as a corporation, they might be subject to the same problem of the traditional finance of banks, where you might find, for example, a problem of liquidity mismatch. And so you might find a problem of liquidity, because maybe if I am a participant of the ETF and I hold those shares, usually I don't hold the shares in my name immediately. I have an intermediary. This intermediary is called authorized participant, and usually it's an investment bank. It's a very large financial institution and qualified investor. And so the qualified investor that is called within this world of ETFs is called authorized participant, is the only one that can redeem the shares. And we don't know how many shares is going to redeem, when is going to redeem, on which basis is going to redeem. But we know that the management, or in general, the ETF fund managers, they need to find money to pay back that investor. And this is a problem that can generate, as you might think, a disruption of the market, and can also generate the possible collapse of the ETF fund. If the ETF fund is going to collapse, this might generate a systemic effect within financial markets, because, of course, always the value of the shares of the ETF is connected to an underlying asset. And so even the value of that underlying asset can in reality suffer from the collapse of the ETF that was replicating the value below. And this is something that can generate actually potentially systemic risk. This is the reason why essentially, I mean, even in March 2020, once there was the inception of the pandemic, for example, the central bank, that is the Federal Reserve in the US, announced that it would buy ETFs in order in reality to stabilize the market, in order in reality to arrest a vicious circle of financial instability. So these are real events that happen and are very recent. So this is the reason why I was speaking to you about this, because I think and I found it very interesting that this is a new topic, a topic that in reality will go always higher and higher in consideration. Also because the value of the transaction of ETF is reaching, for example, as you can see, the asset under management hit 10 trillion in 2021 in terms of USD dollars. So the asset under management is the same thing. You remember the first slide. The first slide is the concentration of capital. This concentration of capital, I am the manager of that capital, of that pot. That concentration of capital in finance jargon is called asset under management. So the asset under management of ETF funds reached 10 trillion just in 2021 and is going always higher. ETFs, for example, here, I mean, there was just now in January 2024, the Security and Exchange Commission, after many years of disputes, approved ETFs for Bitcoin, so a cryptocurrency, so decentralized finance. And this Bitcoin exchange traded fund were issued, and so there was a possibility for investors to invest in Bitcoin through ETF. And so through creating a new type and typology of financial innovation that we need to still see, I mean, how this then is growing further. Any question until now? Okay. So we can go with something that maybe every one of you should know. I think you are more used to this hedge funds. What is an hedge fund? Do you know hedge funds? So hedge fund also, both in the US. It is the man, Alfred Jones, he invented the hedge fund. He set up in the past, in 1949, the first hedge fund in the world. So from that moment, he started in reality to collect money of people, of investors, and to invest those money in other financial assets, in other investments, and wanted to create a return for its own investors. So you see the same story of Rome, ancient Rome. And he invented, in reality, he didn't really invent it, but he took, as you can see from the slide, from a very old tradition of Phoenician merchants, that they were, in reality, every time that there was a voyage by the sea, the ship captain was taking 20% of the profit from a successful voyage. So the famous rule 220, this rule 220, that is the remuneration for managers of the hedge fund, has been for the first time applied by Alfred Jones in 1949 in the US, but he took this idea from an old idea of 2000, even more than 2000 years ago, of Phoenician merchants. So it means that he will, by the end of the financial year, he will take 20% of the profit if the investments were successful. And in addition, just for managing the fund, he will take 2% of the value of the capital that is going to manage. So this is the reason why hedge fund managers are quite rich, hedge funds are quite profitable, but also an hedge fund is always different from a mutual fund. For example, if you are a retail investor, you cannot invest your money in a hedge fund. You will invest this in a mutual fund. Mutual funds, I mean, are different because they don't follow the strategies, the dynamic investment strategies of hedge funds. Hedge funds, they have so many strategies. And I mean, you can find the four, in reality, broad groups of hedge fund strategies like arbitrage, event-driven, equity-based, macro. So in reality, usually the hedge funds, they try to find a loophole maybe in the system and to take advantage of that loophole in the system. That is called also financial arbitrage. So they don't do this really with legal rules, but they do this by playing with numbers and by finding out whether maybe they might, I don't know, in the case, if I think about something that I'm very expert, that is the case of special purpose acquisition company, they might find out whether they can maybe redeem shares of those companies, but still keep other maybe assets, and these assets in reality they might turn more valuable in the future. So that is a sort of financial arbitrage. So it's something that you see, you study the condition of the market, and you might do a switch of assets in the right direction. So usually fund managers are those, in the case of hedge fund manager, are those that they know the market better than others. Hedge funds are the speculator of financial markets. Hedge funds, I mean, fund managers are the one that they know the market better than others. And this is why they make a profit. And they usually take a fee, as I told you, a management fee of 2%. So that is the famous rule 220, because then they take also the 20% on profit at the end of the financial year if the investments proposed and made were successful. And here you have all the list of, I mean, it's only one part, can be much, much longer, of all the different strategies that are dynamic and all the different strategies that hedge funds they might implement. Like they might even invest only in financially distressed companies. They might maybe invest only in emerging markets, only in technology, or they might have a multi-strategy investment strategy. I mean, there are so many. You are more lawyers, so I mean, you need to be aware that there is a broad conception of strategy, but you might also be aware from the point of view of regulation that hedge funds in the US, but also in all the world, they are not like mutual fund. This is something that I told you. So they are not even subject to the regulation of mutual funds. And so they are not investment companies in the US. They are not subject to the Investment Company Act 1940. And this exception, usually you see in the US, you might have two exemptions, the 3C1 or the 3C7. The 3C1, it depends on the number of investors, because as you can see in the first option, you cannot have more than 100 investors, and these investors, they must be only accredited investors. So they are investors actually that are qualified investors. They are institutional investors. They are not retail investors. They also might be in the US retail investors, but to be an accredited investor in the US, you must be an individual that you possess at least assets for the value of $5 million. So in that case, even if you're an individual, you can invest in the US and invest in hedge funds. Otherwise, only accredited and qualified investors. And then the other exception from a point of view of the law for hedge funds managers is the 3C7 exception, where in reality you can only have as always qualified investors, purchasers, and you cannot have more than 499 investors. Usually, hedge funds, they had only this kind of regulation. They didn't have to report anything about their own strategies or about even how they were investing those money to the regulator. The regulator in the US in terms of securities is the Securities and Exchange Commission. But then after the global financial crisis, because many investors of these CDOs and so on, they were also hedge funds. For this reason, the Dodd-Frank Act, that was the main act in 2010, that was enacted by and signed off by President Obama, they wanted in reality to limit the operation of hedge funds in the sense that at least they wanted to monitor what hedge funds they were doing. So if now you are an hedge fund in the US and you have asset under management more than $115 million, you must register with the Securities and Exchange Commission. So you must do this because in this way the regulator can monitor what you are doing and can in reality take steps in order to mitigate the possible risk that can born from the fact that an hedge fund can maybe collapse. This is not new. I mean, we didn't need even the Dodd-Frank Act because already in the 90s there was long-term capital. If you are curious, you can go to look it up. Long-term capital was an hedge fund. So this kind of possibility that an hedge fund can generate systemic risk or can generate potentially, I mean, systemic liquidity crisis. This is something that is not uncommon. We didn't have to wait 2007, 2008. You can also go back in the 90s, and already there was a problem with hedge funds and the strategies that maybe they were deploying. Then, if we go in Europe, so if we are in the US, we will follow the rules that I told you just now. then if you are in Europe, you follow the Alternative Investment Fund Managers Directive. It is a directive, so in reality then each member state in Europe has to implement the directive. And in that case, I mean, being a directive, it means also that each member state is obliged to implement. It's not discretion, it's obliged to implement the directive. This directive applies to the managers. So applies in reality to, here you will see this definition, UCITS. UCITS is the definition for the mutual funds in Europe. So this directive actually doesn't apply to alternative investment funds, including hedge funds, does not apply, but applies to the management. So as you can see, the managers of alternative investment funds, which manage and/or market such funds in the union. So in reality, I mean, here you have like an example. These are alternative investment funds, hedge funds, private equity funds, venture capital funds, real estate funds, art funds, so funds that invest only in art. Those are alternative investment funds. They are not subject to this Alternative Investment Fund Managers Directive, but still this directive might apply to the management. So there are some conduct rules that are prescribed for managers. This is what we do in Europe. So in reality, even in Europe, alternative investment funds or hedge funds are not so much regulated like in the US. So then the question is, why is not so much regulated? And this is also because of the power of the lobby of this industry that is going always and is successful in also avoid further regulation. But it's also true, as I told you at the start, that those are non-bank financial intermediaries. So they are not completely within our conception of traditional finance. So, for example, just to understand, you remember the four pillars of traditional finance. If an hedge fund is going to collapse, I cannot ask money to the central bank. That is for banks, for example. Or if an hedge fund is going to collapse, the investors, they know that they don't have deposit insurance. They don't have it because also they have a return on equity that is much higher. So sometimes in our conception of capitalism, higher the risk, higher the profit. So that is why you don't have sometimes that regulation, because in hedge funds, we have majority, or not only majority, as we said before in the rules, they are all qualified investors. So a retail investor, it's difficult that can be there. Although in the US, yes, if you are a very wealthy individual, you can be an accredited investor, and as an accredited investor, you can invest in a hedge fund. But you can understand with at least 5 million in asset, you have a buffer in case the hedge fund is going to collapse. But if you are a retail investor, no. So this is the reason why a normal person, a retail investor, cannot invest in those instruments. And it is also the reason why there is less regulation, because the main concern of regulation, always, majority of times, is the interest of the consumer of financial services, is the interest of the retail investor. So in mutual funds that are investment companies in the US, and in Europe, we call them UCITS, so collective undertakings in transferable securities. So this is something that is a definition invented by Europe, but is the equivalent of an investment company in the US. In a mutual fund, you will invest, you can invest, so rather than depositing your money with a bank, you deposit your money with a mutual fund. Mutual funds are well regulated because normal people, they might invest. Hedge funds, art funds, venture capital funds that are all belonging to alternative investment funds, much less regulated. And this is something that you see here in the last slides, that is actually, I mean, giving you this perspective in Europe and is giving you, in reality, a summary of what I said. Is a typical investor. If we are a mutual fund, so if we are what is called in Europe a UCIT, we are retail investors. If we are, on the other end, within alternative investment funds, you are always a sophisticated investor. So different kind of rationale. This is the reason why the level of regulation is high in UCITS and is low in alternative investment funds. And with this, I mean, I think I can conclude here my presentation, and I open the floor in case you have any question or doubt. I'm very happy to clarify, and then maybe I can even send, I don't know, the slides to Catherine if she wants them or you want them to read the further. Thank you very much. I don't know if Catherine is here, but I think, yes. I think, I don't know, we need to wait just for Catherine to close the event, I guess. A second that I... Any question? Meanwhile, we wait maybe for Catherine that she's going to close the event. What is yours? Yes, please.
Fernando ha planteado alguna preocupación, porque aquí se habla de riesgo, se habla de oportunidad.
Yes, I wanted to ask, what is your specialization? You are all lawyers in Colombia.
Yeah, exactly. I wanted to ask you about the art fund, because I feel like that's not common here in Colombia.
Yes.
I didn't have to hear like that figure here.
Yes, I can.
So will you want to like explain it a bit further? Because I feel like art here is not that appreciated, like in value, like money value, you know?
Yes, essentially, I mean, this is something that, I mean, you can find in the US, you can find in Europe, because also in London there is not that kind of auction houses like Sotheby and so on, I mean, where they sell art. Art, until very few years ago, was very profitable, because actually, I mean, in art, you didn't, the capital gain was not taxed. Now they are taxed. So, I mean, it depends even there what kind of art you invest on. I mean, you need to be very expert on these things and not expert in art in terms of tax regimes, for example. But I know, I heard that it's different now, the situation. What they do, Art Fund is an alternative investment fund. So rather than investing on the financial markets, like maybe they're, you know, an hedge fund might invest in securities like bonds, equity. In that case, no, they really invest in a commodity that is a piece of art, like a painting, like a sculpture. They buy those sculptures and then they resell at higher value. This can be something that is done, but also an art fund might also carry out techniques that are similar to mutual funds, because if you are interested maybe to buy Picasso, but the fact is that you don't have enough money to buy alone one painting of Picasso, the art fund can even maybe sometimes find out that there are in the world, I don't know, 300 investors or even more, and can, what is going to do is that is going to buy that piece of art and then is going to ask money to investors, and each one is owning one piece of that art, like dividing the painting in shares. And that it can be profitable because then maybe the art fund is going to sell again the painting, maybe 3 times the value that was buying the painting. And that is interesting because if even you have maybe 2% of the painting of Picasso, maybe you bought 3 years ago and now they sell after 3 years, and maybe you have a good capital gain. So that is an art fund. It's a fund that is investing in art. Could invest even in wine, could invest even in whiskey, could invest. So the funds, they are funds. So in reality, they collect money and they invest that money. This is what they do. And they try, if you are the manager, you need to create value for the fund, but also a return for your investors. I hope
All
this.
right, thank you so much for answering.
Yeah. Yes, then I mean, I write also in the chat, maybe I write my email address, so that if you need anything, I can always, I mean, be in touch with you. If you are in London, we can meet for a coffee. If you are, I don't know, you want to ask a question that is more related, maybe you want to read more. Even, yes, you, Natalia, I think if you want, I can give you, if you send me then an email that I gave you now, my email, you can essentially, I mean, write me and I can give you also more readings, because there are
All
readings.
right, thank you so much. I appreciate it. Thank you.
So let me check, because I think Caroline is in a call, probably. I think, I mean, I'm happy to take any other question if there are no other questions.
I'm here. It's that I'm attending a meeting at the same time as of her.
Yeah, no, but I think, I mean, we can even close the event if there are no other questions. I gave to them also my email. So thank you very much.
No, thank you. Thank you for being here, for all the things that you share with them. I think that there are many questions that will come along the reflection upon these topics. And I want to invite you for the next year, for the next year version of the course, of course. And all of you, thank you for being with us today, and have a lovely here afternoon, then morning. Thank you so much.
Thank you very much. Thank you, guys.
Thank you very much, Tano.
Bye-bye.
Thank you.